All right, we're going to break down something we all use every single day, but most of us don't really think about: money. And trust me, how it all works behind the scenes is way more fascinating than you might think. Let's jump right in. I mean, think about it. It's in your pocket, it's in your bank account. You work for it, you spend it. But what is it? What is money actually? And maybe more importantly, where does it even come from? Well, the answers are probably not what you're expecting. So, first things first, what is money really? To get our heads around the entire system, we have to start with the absolute basics, the foundation of it all. Okay, so here's the textbook definition. And that word set is actually super important. Money isn't just cash. It's a very specific set of your belongings that you can use to easily buy stuff, like the cash in your wallet or the balance in your checking accounts. And that's what makes it different from your total wealth. For anything, and I mean anything, to be called money, it has to do these three jobs. No exceptions. It's got to be a medium of exchange, which just means you can use it to buy your morning coffee. It has to be a unit of account, so the coffee shop can put a price on that coffee, like $3. And it needs to be a store of value, so you can save those dollars today and still be able to buy coffee with them next week. And this is a super common mix-up, right? Money versus wealth. The key thing to remember is that your money is a part of your wealth, but not all your wealth is money. You can't just walk into a grocery store and try to pay with like a piece of your car's bumper. And the reason why brings us to a really important idea. And that idea is liquidity. Honestly, when it comes to money, liquidity is everything. Cash is basically the king of liquidity. It's as liquid as it gets. A house, on the other hand, is super illiquid. It takes a ton of time and effort to turn your house into spendable cash. Money, by its very nature, has to be liquid. Okay, so we've got a handle on what money does, but what about where it gets its value from? This is where the story gets really interesting, because we see this huge historical shift from money that was valuable all on its own to the money we use today, which is valuable just because we all agree it is. So you've got two main types. On the one hand, you have commodity money, like gold. A gold coin is valuable because the gold itself is valuable. But on the other hand, you have what we use today, fiat money. A $20 bill, it's just a piece of polymer. Its value comes from two things: a government decree saying it's money, and, this is the big one, our shared trust in the system. All right, get ready for this, because this is the part that blows most people's minds. The vast majority of the money in our economy is not printed by the government. Nope, it's created basically out of thin air by normal commercial banks every single time they give out a loan. Let's see how they do it. The magic, if you want to call it that, happens because of a system called fractional reserve banking. It sounds complicated, but the idea is actually pretty simple. When you put your money in a bank, the bank doesn't just stick it in a vault. By law, it only has to keep a small fraction of it on hand. The rest, it lends out. Okay, let's walk through a super simple example. Just follow the money here. Let's say you get paid, and you deposit $1,000 into your checking account. Right there, in that moment, the journey of creating new money has just begun. Now, let's say the bank has what's called a 10% reserve ratio. All that means is it has to hold on to $100 of your $1,000 deposit. But the other $900, it's free to lend that out to someone else. And here is the crucial step. The person who borrows that $900 doesn't just sit on it, right? They go out and spend it, maybe on a new TV. The person who sold the TV then takes that $900 and deposits it into their bank account. So think about what just happened. You still have $1,000 in your account, and now someone else has $900 in theirs. Just like that, the money supply has grown. And get this, it doesn't stop there. That new $900 deposit, that bank can now lend out a fraction of that. This process repeats over and over, creating a ripple effect. And that powerful cascading effect is called the money multiplier. The formula is actually really simple. It's just 1 divided by the reserve ratio. So what does that all add up to? Well, here's the big reveal. With that 10% reserve ratio, the money multiplier is 10. That means your single $1,000 deposit can end up supporting the creation of up to $10,000 across the entire economy. That is the incredible power of fractional reserve banking. So you might be wondering, wait a minute, if regular banks are creating all this money, who's in charge? Who's making sure this whole thing doesn't just go off the rails? And that question takes us to the economy's control room. Well, that's where the central bank comes in. In Canada, we call it the Bank of Canada. Think of it as the bank for all the other banks. Its main job is to manage the country's money supply and hopefully keep the whole financial system stable and running smoothly. A central bank has this toolkit, a few really powerful levers it can pull to steer the economy. It can mess with interest rates to make borrowing cheaper or more expensive. It can set safety rules for banks. And, this is the most important one, it can directly inject or remove money from the system. And it does that using something called open market operations. And this is their number one tool. To pump more money into the economy, the central bank will buy things like government bonds from the commercial banks. It pays for those bonds with brand new money that it creates. This floods the banks with new reserves, which means, you guessed it, they can lend out even more money, kicking that whole money multiplier into high gear all over again. Now, this system of creating money through loans is obviously super powerful. It fuels economic growth. But, it's not without its risks. What happens if a whole bunch of those loans suddenly go bad? That's why keeping the system stable is the name of the game. Okay, let's peek under the hood of a bank for a second. On one side of their books, they have assets, which are mostly the loans they've made. On the other side, they have liabilities, which are mostly the deposits they owe to customers like you and me. And that little sliver in between, that's the bank's own money, its capital. And that capital is an absolutely crucial safety cushion to absorb any losses. The thing is, banks are highly leveraged, which is just a fancy way of saying they've borrowed a ton of money compared to their own small cushion of capital. And that leverage magnifies risk. Just listen to this. If a bank's assets, all those loans it made, drop in value by just 5%, its entire safety buffer, all of its capital, could be completely wiped out. And that really gets to the heart of the challenge here. Even with all those powerful tools, the central bank can't have perfect control. Why not? Because at the end of the day, the system's behavior depends on the choices of millions of ordinary people and thousands of individual banks. People might decide to save more, or banks might decide to lend less, and there's not a whole lot the central bank can do about that. So, let's end with this one big question. The money we use every day, the foundation of our entire economy, is created mainly through debt. And the whole system is held together by our collective trust and confidence. It's an incredible engine for prosperity, for sure. But it also has this built-in fragility. It works, fundamentally, because we all believe it works. And that's definitely something worth thinking about.